Welcome to another edition of Econ Updates. I'm Steve Taddie, Chief Economist with Hoyle Cohen Wealth Management. Now, the turn higher in the leading economic indicators, or the more frequently reported economic data points, did not disappoint, with the U.S. economy logging a 4.9% annualized increase in GDP. Great number, but it really pales in comparison to the 8.6% nominal GDP growth number, and nominal being just raw economic growth without inflation being subtracted away. Now, it's that 9% annualized growth number that doesn't quite square with the 9% decline in the price of the S&P 500. Now, I get it. There's a good point to be made, an argument to be made, that it's more about rising interest rates than it is rising economies. And I get it, because 15 years ago, interest rates were at about this same level and PE levels were lower. But in the decades prior to that, both interest rates and PE levels were much higher. And to get back to an 8.6% nominal GDP growth, one has to revisit those prior decades of higher interest rates and higher PE levels. Now, inflation, the Personal Consumption Expenditures Price Index, one of the Fed's better gauges of inflation, which is why it's something that we watch. The report was okay. It wasn't quite the lukewarm porridge that Goldilocks would have preferred, but it showed a continuation of the bumpy ride lower in inflation from year-ago levels. Now, that said, the forward numbers, when we look at consumer price index, a number we all are familiar with, in the next 12 months, there will be 3 data points, 3 month-over-month increases of about 0.5% that will go away as we get past 12 months. So all else being equal, if the economy continues to generate lower inflation numbers, will drop off those higher inflation numbers, which might mean we have a decline of about 1% of CPI in the cards for the next 12 months, all else being equal. All good things. Now, the market's turn lower has hurt market portfolios. And those of us that have been lifelong investors, we've been here before. And the markets, while they've broken some key support levels, it seems to be nearing a point of being overdone. But that said, the slog back to historic valuations and more recent valuation levels, market prices, it may be a slow one. Growth is not a bad thing. Growth is good, and if inflation can remain contained, then good economic news should translate into good news for the investment markets. Now, if the economy were stalling, and new orders, revenues, and earnings were under significant pressure, I think I'd be a little bit less optimistic. Now, there's not much one can do about international diplomacy or even our own dysfunction in Washington, except continue to vote with your head. And now we have a speaker. Great. And the next step up is ratifying the budget, which is about 2 weeks away. Let's just hope that this time around, cooler and more mature heads can prevail, and we can keep the ship pointed in the right direction. That's where we start the week. Thanks for tuning in.